Welcome back, and nice job on that quiz. Looks like you did pretty well. And I hope you enjoyed that and you're enjoying the class as much as I am. But now we're on to the next topic with regulatory accounting and something called decoupling. Now, decoupling on the surface sounds like a big breakup that you have with your significant other, and it really is in accounting terms, but ironically, this method of decoupling allows you to get back together and better than ever. So let's check it out and explain it a bit and then see how it relates to regulatory accounting. Decoupling, what it does is you'll have an annual budget and your revenues will come out and your expenses will come out on a month-by-month basis. And perhaps halfway through the year, partway through the year, you notice that you're missing your budget target on the revenue side. And maybe you have implemented a program for energy efficiency, maybe more distributed generation customers, maybe more solar generation that you're getting from your customers, and you hadn't anticipated that in your budget. Well, decoupling is a way to capture those missing dollars, put them on your statement of net position, and then recover them from your customers in future periods. If you have a purchase cost adjustment clause or a fuel cost adjustment, power cost adjustment, you call them a PCA and FCA, PCAC, something like that. If you have something like that, this is kind of similar to that, but what it does is it hones in on the reason, the event, for missing your budget target. And there are ways to determine that by comparing your sales that you budgeted on a kilowatt hour basis compared to what you're actually selling, work and weather, things like that. You'll come to the root cause of the problem. And again, decoupling captures the missed revenue targets due to unanticipated events. And the main use that I have seen this in utilities is to record missed revenue targets due to distributed generation, as I said, that wasn't forecasted in that original budget. So the process decouples, in other words, identifies the cause of the revenue shortfall, or sometimes it's an overage, but it's mainly a shortfall. And you take that amount and you record that as a regulatory asset or liability on your statement of net position for future inclusion in customer rates. It's almost like you get a do-over on it. We were off on the budget and we're going to need to collect this from customers in future rates. But let's apply this to a situation. Here we have a utility that it's 6 months into the current budget year and they determine they have a $1 million budget shortfall. And coincidentally, they had launched a solar incentive program this year to encourage customers to add solar generation to their residences. It was a huge success. People took it on. The solar panel sellers were out in the neighborhoods doing their deals. You see a lot of panels on homes, and you see the kilowatt hours go down in sales for the utility. So the utility does some analysis, and they determine that sales are lower due to more of the solar generation being placed into service than was forecasted for the program. So it's a two-edged sword. You want more renewable generation, but there's a cost that comes with that, and it's hard to forecast that, especially as we are in more of the early days of renewable energy being adopted on a wider scale. What happens is there's a cash flow issue for the utility. You say, well, we're selling less kilowatt hours. What's the issue? Because that should cut our variable cost. Well, the way utility rates are set, a piece of each kilowatt hour contains a contribution towards the utility's fixed cost. That cash that you generate from the fixed cost is used to pay debt service, depreciation on your assets so that you can replace them, and things like that. So there is now less cash available from sales revenue to make payments on those fixed costs. And the utility wishes to recover this fixed cost shortfall in future rates, saying, well, we messed up here, but going forward, we're going to need to recapture some of those dollars so that we can make those fixed capacity and debt service payments. Otherwise, we'll have to use unrestricted cash, unplanned resources, and so on. So it's a missed revenue target, but still it's something that can't be ignored. Now, the ethics strategy for this utility is they go to the oversight board with a resolution to record a regulatory asset for $1 million budget shortfall and to recover this amount through utility rates over a 10-year period. This is not something you would do with a blanket resolution to your board. I'm sure this would take a couple of meetings with some PowerPoint presentations on explaining exactly what decoupling is and making them understand or helping them understand what the issue is and why you need to do this, because it's not at first blush really apparent to the outside observer. But our board sits through those meetings and they say, all right, book the shortfall and we'll approve the resolution. In year one, we need to book this $1 million revenue shortfall as a regulatory asset. We debit 182.3 other regulatory assets for future revenues for rate recovery. This is the $1 million shortfall. And now we have, in effect, a deferred revenue that we're going to recognize in future periods. And this becomes a regulatory liability. We use FERC 254, other liabilities, deferred revenues for $1 million. Now in year one, we say, okay, remember the recovery period is 10 years. In year one, we need to recover $100,000 of that $1 million, 1 million divided by 10. The first part of the entry, we reduce the regulatory liability for deferred revenues and we recognize that $100,000 of revenue. And we also reduce the regulatory asset, recognizing that we have now recovered or placed into rates $100,000 of that shortfall. And the entry to customer accounts receivable is showing the billings to our customers for that revenue shortfall. And each year, the amount included in utility rates is reflected in a similar entry. And the regulatory asset and liability are like a balancing account, like a FCA, PCA, those types of things, just to show that the amount that has been recovered in rates and the remaining balance to be recovered in rates. The impact on rates is that rates are increased by $100,000 per year for 10 years for this transaction. Now the tricky part is if you include this $100,000 in your kilowatt hour charge, well, the customers that are causing you the problem or the revenue shortfall are the solar distributed generation customers. They are using less kilowatt hours. So including the $100,000 per year in the kilowatt hour charge means that the customers that are buying kilowatt hours from you are paying for the shortfall caused by the other customers. So there isn't really rate equitability when it comes to that. Now, this is not a rates class, so we're not going to really address that. But what I have seen utilities do is try to roll this into the fixed charge for customers, and that isn't totally equitable either, although it does have the solar customers paying for some of that shortfall, or having a solar surcharge, which in effect kind of defeats the purpose of encouraging solar distributed generation. There aren't any easy answers on this. I think the most fairest one I've seen is trying to roll this into the customer fixed charge. In the financial statements present as a current asset and liability the amount that's going to be recognized as revenues in the next 12 months, and the remaining balance is presented as a non-current asset. In GASB, it's a deferred inflow of resources on the liability side, or a deferred credit if your utility follows FASB. See on the presentation here, the current asset is the $100,000 to be recognized in the next year. The $900,000 is the non-current asset remaining to be recognized, and the liability side of the financial statements reflects the same information. The key takeaway from this section is first off to understand what decoupling is. Decoupling is used to record missed revenue targets due to distributed generation that was not forecasted in the original budget. Again, it's the do-over on your budget for unanticipated events. The unanticipated event piece of it is something that makes it ripe to use regulatory accounting in your financial statements and rate recovery from your customers. Again, the intent standard that we follow anytime that we want to use regulatory accounting. This isn't for every utility, but if you find yourself in a situation where you can fully define the event that is causing your budget shortfall, you might want to consider this approach in using regulatory accounting for rate recovery. If you're in the situation where you blew the budget and your forecast was off, I really don't think that this is an appropriate approach to do that. But just know that this tool is out there in case you need it and want to use it. Now we're going to take a quiz just on decoupling. So take the quiz, admire your score, and we'll see you on the other side where we'll discuss discontinuing regulatory accounting and what happens to your financial statements when that does happen. Thanks a lot, and we'll see you on the other side.